Welcome back to Morning Trade Live. I'm Nicole Petalides. We're seeing stocks somewhat mixed today. The S&P higher, the Dow lower. Glad you're with us here. We're live at the New York Stock Exchange. It's time to go inside out on consumer staples and some names that you'll want to follow. Garrett Nelson, Vice President, Senior Equity Analyst at CFRA Research, covers the gamut. You have all kinds of names that you cover. We're covering two today, including Keurig Dr. Pepper. I saw a double beat for this name. What was the takeaway from the earnings report, and what are you watching for this name going forward?
Sure. Thanks for having me. So Keurig Dr. Pepper, it was a bottom line beat. Their EPS came in 4 cents ahead of consensus. However, it was a relatively low quality beat in our view. The bottom line beat was really driven by a lower than expected tax rate. So if you look, the top line fell short. They fell short on the gross margin line. The positive is they maintained their full year guidance on the same morning that we saw Pepsi lower their full year guidance. So, citing the impact of tariffs on supply chain costs. So, all in all, I think, despite the beat and maintaining guidance, you're seeing the stock trade a little bit lower here, and I think that's mainly because it was a pretty low quality beat.
So when we think about the products that Keurig Dr. Pepper has under the umbrella there, you mentioned Pepsi lowering the guidance. We have RFK really looking closely at things, whether it's food dyes or health, and what are in the things that we're consuming. I wonder whether or not that hits some of these consumer staples or some of these soda type drinks. And then you have tariffs and what people are going to spend. I mean, Chipotle noted that customers are looking to save a little money. Tell me a little bit about some of those things.
Yeah, so if you look at Keurig Dr. Pepper's top line, it was up about 5%. For the quarter. Most of that was driven by volume and mix, which was up 3.6% for the quarter. So those are actually pretty respectable numbers in this environment relative to both PepsiCo and Coca-Cola. The reason we think they're able to maintain their guidance, being less impacted by tariffs and inflation on their supply chain costs, is because they're very levered to the U.S. market. If you look, 87% of the revenue was generated in the U.S. last year. That's a much higher U.S. exposure than either PepsiCo or Coca-Cola, which are much more internationally levered. So we think that's why this release is stronger than what we saw from PepsiCo this morning, who actually reported only their second bottom line miss since 2008. So, pretty surprising miss and lowered guidance from PepsiCo.
Mm-hmm. And what is your price target on this one? It's at $35 today. And are there any names in the staples sector that you think are some of a buy or a screaming buy?
Yeah, so our current price target is $36. We have a hold on KDP. We like the consumer staples sector because it really provides a degree of earnings stability. It's all about earnings stability in this environment, whereas you look at consumer discretionary, we're seeing estimates for a lot of those companies being slashed. Obviously, the consumer under a lot of pressure right now, and all the uncertainty related to what tariffs are going to do to costs. So we think a lot of consumer staples companies are better positioned than in the discretionary space at the moment.
There's a headline crossing on MarketWatch that Elon's not going anywhere. Trump White House says Musk has more to do at Doge. Yesterday, we heard that Elon Musk would be stepping away from Doge significantly and focusing on Tesla. We also heard that there was some loud conversation between Treasury Secretary Bissett and also Elon Musk. So maybe they had a fight. I don't know. I mean, it is so much speculation. But what are you thinking about Tesla now? I mean, we know the brand's been damaged. The stock's down. The sales are down. They still make more money than some of the others per vehicle. Where are we going with Tesla?
Yeah, so we lowered our rating on Tesla to hold. We've been a bull on the Tesla story for a long time. what really disturbs us about the situation, when we make a list of both pros and cons surrounding the story, we come up with a relatively equal number of both positives and negatives surrounding the story. So in our view, that really justifies a hold opinion. I think the biggest concern is the loss of market share that they're experiencing across all three of their major markets in the US, in Europe, and China. And in our view, there's not going to be, this V-shaped recovery in earnings anytime soon. Tesla is in a transitory period. The only new model they've brought to market in the last 5 years is the Cybertruck. The Model Y debuted in March of 2020. So it's been over 5 years now, and they just don't have a lot of new products, and they won't in the next year or two to really drive that both the top and bottom line growth. And so we think, being on the sidelines is the right place to be, kind of taking a wait and see approach and seeing how the story evolves.
I mean, he noted the cheaper model is still in the works. You don't feel like that's coming?
Yeah, we think the guidance that they provided, achieving volume production of the Cybercab next year is just really too ambitious. And we've seen that many times over the years where, a future product that they've provided a timeline for gets delayed. The Cybertruck was delayed by 3 years from what they initially said. So we're skeptical of that timeline. And as far as Elon, stepping back from Doge, he's not quitting Doge. He said on the call, he's only going to dedicate maybe 1 or 2 days a week to it. So I think the jump in the stock yesterday in reaction to that announcement was maybe a bit overblown.
Let's talk about some of the other names that you've followed for so long. I mean, I know you had a few sells on some of the names in the electric vehicle market. Tell me about some of the sells and the buys.
Yeah, so we're largely neutral on the EV makers or on the auto industry as a whole. We have a hold on Ford, on General Motors. We have a sell on both Lucid and Rivian, and of course a hold on Tesla now.
All right, so there's no buys there. Whatever happened to Polestar? Whatever happened to Polestar?
Yeah, I didn't mention that either. We have a hold on Polestar right now. Stock's currently, hovering right around $1, and that's our price target.
I pay attention to what you say to me, Garrett, and I also take notes because then I refer to them later and say Garrett Nelson said. And but right now a sell on Lucid and Rivian, and I think you said that last time we spoke, so that hasn't changed at all. Thank you so much, Garrett Nelson. Always great to see you and have you on the show. Appreciate it. CFRA Research, Garrett Nelson. George Tsilis is here. So George, great to see you, and I know you have a bullish example trade to tell us about Tesla.
Yeah, I mean, one of the things about the conference call, obviously there's constructive elements to Tesla going forward, but in the near term, maybe in the next couple of quarters seems to be maybe neutral in terms of the previous analysts' price target, but also considering the outlook for the company. So one of the things that's going on, if you look at the chart since early March, it's really been in a trading range as a stock between 220 and 280. High and low, and that's actually quite constructive considering the markets which have been to the downside in that same time period. So with that said, we can place some neutral to bullish trades, taking into consideration the aspects of essentially what's going on with volatility. And so if you're really bullish on the stock, but you do expect potentially some resistance around that 280, you could certainly structure a bull call diagonal going out to June, effectively for the long call option. So in this case, we could actually sell the nearer term May out of the money 275 call, and we can use those proceeds to finance the June in the money 250 call. Altogether, it would cost you about $19 a share or $1,900 per contract. And in essence, it allows us flexibility because there's a lot of volatility still in these options and the market. It neutralizes that volatility. Is particularly you're getting a little bit more positive Vega in this particular instance because that May contract has quite a bit more volatility than the June one. But with that said, effectively you have 22 days to participate to the upside on this trade in terms of being capped at $269. Ideally speaking, that's your break even if you do hold the position until the end of June or the third week of June in 57 days. So in essence, you just don't participate past the 275 in May, to which time, again, that May contract will expire worthless, and you basically have a cheaper June contract to allow it to participate to the upside.
All right, and look here, as we see this name, and it's been under some pressure, there are folks who are really looking forward to full self-driving, robotics, the energy story for Tesla, but the truth of the matter is there's a lot of uncertainty and a lot of market share lost as, so many of the other car companies are making these EVs. So like Garrett Nelson said, how about the neutral trade that you have? Example trade.
Yeah, so I'm also going to... Yeah, so in this case, the previous trade was done for a debit, but it also neutralized volatility. So if you're more neutral to bullish, but you want to earn a credit, what you could do is sell some downside put spreads. In this case, what I'm going to do is I'm going to go to a narrower time frame for the May monthly expiration, so that we have accelerated time decay. And I'm going to sell the 230 220 put spread. So I'm selling the 230 put. And then I'm going to buy the 220 put below that. So you could harvest about $2.50 a share in credit, or $250 a contract. So the whole objective of this trade is for the stock to stay above 230 between now and expiration in the next 22 days. Break even is 227.50 in case it falls to that level, and 750 is your max risk versus the 250 max gain. And that only occurs if the stock hits 220 or lower by expiration in 22 days. But again, that 220 level is that area of support, which corresponds to multiple touches going back to early March.
George Tsilis, great to see you. Thank you so much. Appreciate it. Good luck there.